Preparing for a Treasury Analyst at Wells Fargo interview. You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through what a Treasury Analyst does at a large bank like Wells Fargo. A Treasury Analyst helps the bank manage liquidity, funding, capital, and interest rate risk. At Wells Fargo, that means monitoring cash flows, deposit behavior, wholesale funding, securities portfolios, and regulatory metrics like LCR and NSFR. I'd focus on accurate daily reporting, explaining drivers behind movements, escalating exceptions, and supporting forecasts that help leadership keep the balance sheet safe, efficient, and compliant while serving customers reliably. While answering, focus on liquidity, funding, capital, balance sheet risk, regulatory reporting, and business partnering. Show that Treasury is both analytical and control-oriented, not just cash tracking. Question 2. Why are you interested in a Treasury Analyst role at Wells Fargo? Wells Fargo interests me because Treasury sits at the center of a very large, deposit-rich banking franchise. The role combines market awareness, regulatory discipline, data analysis, and business judgment. I like that Treasury decisions affect funding cost, liquidity resilience, and customer-facing businesses. My background fits that mix because I enjoy working with large datasets, building forecasts, and translating numbers into clear risk insights for decision-makers. Make sure to connect Wells Fargo's scale, regulated banking environment, balance sheet complexity, and risk culture. Avoid generic answers. Explain why Treasury work fits your analytical strengths and career goals. Question 3. How would you define liquidity risk in a banking context? Liquidity risk is the risk that a bank cannot meet cash obligations when due without unacceptable losses. For a bank, it can come from deposit withdrawals, maturing debt, collateral calls, unfunded commitments, or market disruptions. The key is not only how much liquidity exists, but how quickly it can be converted to cash. Strong liquidity management uses forecasts, stress tests, high-quality liquid assets, and diversified funding sources. In your answer, talk about the risk of failing to meet obligations, funding sources, cash outflows, asset liquidity, stress scenarios, and why liquidity risk can become severe quickly in banking. Question 4. What is the liquidity coverage ratio, and why does it matter? The liquidity coverage ratio measures whether a bank has enough high-quality liquid assets to cover projected net cash outflows over a 30-day stress period. The formula is H2LA divided by stressed net outflows. If the ratio is above 100%, the bank has enough liquid assets under that regulatory stress framework. It matters because it promotes short-term liquidity resilience and forces discipline around funding mix, deposit stability, and contingency planning. Be sure to mention high-quality liquid assets, 30-day stressed net cash outflows, regulatory expectations, and how the ratio forces banks to hold sufficient liquidity against short-term stress. Question 5. What is the net stable funding ratio, and how is it different from LCR? NSFR looks at structural funding stability over a one-year horizon. It compares available stable funding, such as equity, long-term debt, and stable deposits, against required stable funding for assets and commitments. LCR is more about surviving a 30-day liquidity stress. NSFR is about avoiding over-reliance on short-term funding to support longer-term or less liquid assets. Together, they push banks toward both immediate resilience and durable balance sheet funding. While answering, focus on the time horizon difference. LCR is short-term stress liquidity. NSFR measures stable funding over a one-year horizon relative to asset and off-balance sheet needs. Question 6. How would you build a daily cash or liquidity forecast? I'd start with current cash and liquid asset balances, then layer in expected inflows and outflows by date. Key items would include deposit trends, loan fundings, maturities, securities activity, wholesale funding, collateral movements, and business line forecasts. I'd separate contractual flows from behavioral assumptions, then compare actuals to forecast daily. The most important part is understanding forecast error, because that improves future assumptions and helps identify unusual liquidity pressure early. Make sure to cover starting balances, expected inflows and outflows, business inputs, debt maturities, customer behavior, market assumptions, actual versus forecast tracking, and clear documentation of assumptions. Question 7. If liquidity balances moved materially versus forecast, how would you investigate the variance? First, I'd confirm the variance is real by checking source data, timing cutoffs, and report logic. Then I'd break the movement into major drivers: deposits, loan activity, securities transactions, funding, collateral, or intercompany flows. A variance may be timing-related rather than a trend, so I'd compare against prior days and expected settlements. Once validated, I'd document the driver, quantify the impact, and communicate whether it changes liquidity risk or forecast assumptions. In your answer, emphasize a structured variance process, confirm data quality, isolate business drivers, compare timing versus true economic changes, contact stakeholders, and explain the impact clearly. Question 8. How do rising interest rates affect a bank's balance sheet and treasury function? Rising rates can increase loan and asset yields, but they also raise deposit costs and wholesale funding costs. The net impact depends on repricing speed, deposit beta, asset duration, and hedging. Securities portfolios may show unrealized losses as rates rise, especially longer-duration fixed-rate bonds. Treasury monitors these effects through interest rate risk models, NII sensitivity, economic value measures, and funding plans, so the bank avoids unwanted balance sheet volatility. Be sure to mention net interest income, deposit costs, loan yields, securities valuation, duration, customer behavior, funding strategy, and interest rate risk management through asset-liability analysis. Question 9. What is deposit beta, and why would Wells Fargo Treasury care about it? Deposit beta measures how much a bank raises deposit rates relative to a change in market rates. If the Fed raises rates by 100 basis points and deposit costs rise 40 basis points, the beta is 40%. Treasury cares because deposit beta affects funding cost, deposit retention, and net interest income. For a bank with a large deposit base like Wells Fargo, small beta changes can materially affect earnings and liquidity behavior. While answering, focus on how much deposit rates change relative to market rates, the impact on funding cost, customer retention, deposit stability, and net interest income forecasting. Question 10. Explain funds transfer pricing and why it is useful inside a bank. Funds transfer pricing is an internal framework that charges or credits business lines for the funding they use or provide. For example, a lending business may be charged a term funding cost, while a deposit business receives a credit for stable funding. It helps separate business performance from centralized treasury funding decisions. Good FTP encourages better pricing, product strategy, and risk discipline because businesses see the economic cost of liquidity and balance sheet usage. Make sure to explain that FTP assigns funding costs or credits to business units, supports profitability measurement, encourages sound behavior, and reflects liquidity, interest rate, and term funding costs. Question 11. How would you think about liquidity stress testing for a large bank? Liquidity stress testing asks whether the bank can withstand severe cash outflows under stressed conditions. I'd model scenarios such as rapid deposit runoff, reduced wholesale funding access, higher collateral calls, drawdowns on credit lines, or market value declines in liquid assets. The output should show survival horizon, liquidity buffer usage, and key vulnerabilities. Assumptions need governance because small changes in runoff rates or funding availability can significantly alter the result. In your answer, talk about severe but plausible scenarios: deposit runoff, market funding constraints, collateral needs, unfunded commitments, time horizons, management actions, and governance around assumptions. Question 12. What is asset-liability management, and how does it relate to Treasury? Asset-liability management is the process of managing mismatches between the bank's assets and liabilities. Banks often hold long-term loans or securities funded by deposits and other liabilities with different repricing behavior. Treasury analyzes those mismatches using duration, repricing gaps, NII sensitivity, and economic value measures. The goal is not to eliminate all risk, but to keep interest rate and liquidity risk within approved limits, while supporting profitable balance sheet growth. Be sure to mention matching asset and liability characteristics, repricing risk, duration, funding structure, interest rate sensitivity, and the role of Treasury in monitoring and managing balance sheet risk. Question 13. How are capital risk and liquidity risk different? Capital risk is about solvency and loss absorption. Liquidity risk is about having cash or liquid assets available when obligations come due. A bank can be well capitalized but face liquidity pressure if funding markets close or deposits run off quickly. Conversely, a bank may have cash but insufficient capital after credit or market losses. Treasury needs to understand both, because stress events often connect them through confidence, ratings, funding access, and regulatory scrutiny. While answering, distinguish solvency from cash availability. Mention that capital absorbs losses, liquidity meets obligations, and a bank can have one problem without immediately having the other. Question 14. How do held to maturity and available for sale securities affect Treasury analysis? Available for sale securities are marked through other comprehensive income, so rate-driven valuation changes can affect equity and capital measures. Held to maturity securities are carried at amortized cost if the bank has intent and ability to hold them, but their economic value still changes with rates. Treasury cares about both classifications because securities are part of liquidity buffers, earnings generation, and interest rate risk. Accounting treatment does not eliminate economic risk. Make sure to cover accounting classification, unrealized gains and losses, liquidity usability, capital implications, interest rate sensitivity, and why Treasury tracks both economic value and accounting presentation. Question 15. Suppose your forecast shows a potential liquidity shortfall next week. What would you do? I'd first validate the forecast inputs and confirm whether the shortfall is timing-related or structural. Then I'd identify the drivers, such as deposit outflows, loan funding, debt maturities, or collateral needs. I'd escalate through the appropriate Treasury channels with quantified scenarios and available options, including liquid asset usage, secured funding, wholesale issuance, or business actions. The key is early communication, clear assumptions, and alignment with the contingency funding plan. In your answer, emphasize verification, root cause analysis, escalation, options analysis, contingency funding, communication, and documenting assumptions. Show calm judgment rather than jumping straight to drastic action. Question 16. How do you ensure accuracy and controls in Treasury reporting? I treat Treasury reporting as a controlled process, not just spreadsheet production. That means reconciling source data to approved systems, using standardized templates, protecting formulas, checking period-over-period movements, and documenting assumptions. I'd also build exception thresholds so unusual balances or missing data are flagged before reports go out. If there's a break, I'd escalate it, explain the potential impact, and make sure the resolution is documented for auditability. Be sure to mention reconciliations, source system checks, review procedures, version control, exception reporting, audit trails, documentation, and escalation of breaks. Wells Fargo interviews often value risk and control awareness. Question 17. Describe how you would use Excel or SQL in a Treasury analyst role. I'd use SQL to pull and join data from source tables, such as balances, transactions, maturities, or product attributes. In Excel, I'd build pivot tables, variance analysis, scenario models, and control checks. The goal is not just producing numbers faster, it is improving reliability and explaining drivers clearly. For recurring Treasury reports, I'd look for automation opportunities so analysts spend less time copying data and more time interpreting risk. Make sure to connect technical tools to business outcomes. Mention cleaning data, joining sources, trend analysis, variance reporting, scenario modeling, automation, and reducing manual error in recurring processes. Question 18. What regulatory considerations are important for Treasury at a large U.S. bank? A large U.S. bank's Treasury function operates under heavy regulatory expectations. Important areas include LCR, NSFR, capital adequacy, stress testing, resolution planning, and accurate regulatory reporting. Treasury also needs strong controls around data lineage, model assumptions, approvals, and documentation. For a company like Wells Fargo, demonstrating disciplined governance and a strong risk culture is especially important because Treasury outputs influence management decisions, regulatory submissions, and market confidence. In your answer, discuss liquidity rules, capital requirements, stress testing, resolution planning, model governance, reporting accuracy, internal controls, and the need to operate under strong regulatory expectations. Question 19. Tell me about a time you worked with a difficult stakeholder or conflicting priorities. In a prior project, two teams needed the same analysis but wanted different cuts of the data under a tight deadline. I first clarified the decision each team was trying to make, then created one reconciled dataset with separate summary views. I communicated what could be delivered immediately and what required follow-up. That reduced duplicate work and kept everyone aligned. The lesson was to solve the underlying business need, not just react to requests. Use a STAR structure. Focus on communication, understanding the stakeholder's objective, prioritization, deadlines, data support, escalation when needed, and maintaining professionalism under pressure. Question 20. How would you explain a complex treasury analysis to senior management? I'd start with the answer first. What changed, why it matters, and whether action is needed. Then I'd quantify the impact using a few key drivers rather than overwhelming management with every calculation. For example, I might explain that liquidity declined mainly because of deposit outflows and settlement timing, but remains above internal limits. I'd show assumptions, risks, and recommended next steps, while keeping detailed backup ready for questions. While answering, focus on executive communication. Start with the conclusion, quantify impact, explain key drivers, highlight risks, state assumptions, provide recommended actions, and keep detailed support available. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.